Thanks, everyone. Appreciate the time today. I'm going to talk today about what Moody's is doing around cyber risk assessment and ratings, including a little bit about how the credit rating agency thinks about it and about what we're doing with cyber assessments itself. Just a little backdrop to start with. Moody's, for those who aren't familiar with it, is a 100-year-old global credit rating agency. We've been in the business of credit ratings for as long as the company has existed. And a lot of people ask, well, why cyber? And I think if you think about the existential risks that are facing businesses today, there are really two that are the headwinds in the 21st century. One of them is environment. One of them is cyber. And so Moody's has been doing a lot of work around environmental risk over the last few years. And in the background, at least until the middle of last year or early last year, we've also been doing a lot of thinking around cyber risk. And we think this is important because as a risk management company at its core, we really have to think about these existential risks and how they can impact decision-making, business investments, and even credit. And so that's the why cyber. And if that doesn't convince you, when you look at the World Economic Forum list of top risks, all 5 are either about cyber or environment. So that's why we're doing this and how we're thinking about it from a business perspective. When we talk about the credit rating agency, which is assigning credit ratings to global debt that's issued by corporations and governments, I established a group back in 2018 called the Global Cyber Risk Group. This group was charged with starting to develop techniques, frameworks, and research about cyber risk and the intersection of cyber and credit so that our credit analysts could really start to more deeply understand how credit risk is impacted by cyber risk. And this work really started back in 2015 in the wake of cybersecurity incidents like Target and Home Depot, when our credit analysts started to ask more questions about how this might affect companies financially. So we established a working group back in 2018, and that group has been really focused on this over the course of the last year and a half, but something that has been considered from an operational risk perspective in Moody's credit methodologies for a number of years now. The cyber risk group continues to function even as we stand up cyber assessments and start to think about more standardized cyber risk ratings. And they've put out over 50 research papers and credit opinions and issuer comments about cyber risk and credit over the last year. There are a couple of folks from that team at S4 this week, Leslie Ritter and Leroy Terrelong, who some of you may have met. In addition to that, we really started to think about what we could also do in addition to the intersection of cyber risk and credit that might be more meaningful as a standalone cyber risk assessment product and rating. And so early last year, we started to talk to a number of different organizations about establishing a relationship to start to think about this problem. And we came across an organization called Team8. And interestingly, I think this audience probably is a little more familiar with Team8 than Moody's. And you know them as one of the backers of Clarity. So we became introduced to Team8. And we decided over the course of a number of discussions to establish a company with them to really focus in on building out a cyber risk rating methodology and of course, the tools and the data sets that are necessary to be able to do this in a holistic and a meaningful way, with a secondary goal of starting to build out additional capabilities that could inform credit and be consumed by the credit rating agency at some point in the future. So 2 distinct initiatives that are happening across Moody's globally, one in the credit rating agency and one as part of this joint venture that we've established with Team8. I'll talk a little bit about the credit risk group within the rating agency just for another minute or two, just to give you a little bit of backdrop about how they think about this, and of course would encourage you to reach out to Leslie and Leroy if you have follow-up questions on this. So when I was in the cyber risk group, after we had established it, the first thing we did is come up with a framework for how to think about this in the context of credit. And so we released a white paper last year in February that looked at the 35 sectors that Moody's rates from a credit perspective. And we came up with a basic framework to think about how to assess inherent sector risk across those 35 sectors. One of the things we concluded, which probably isn't a surprise to this audience, is that cyber risk is on the rise. We consider it event risk. And the rise is correlated with the increase in digitization that's occurring globally. And it's also a factor of the complexity of supply chains and the massive amount of data that's being accumulated by companies. When we thought about them in the context of credit and with the start of this initiative that I mentioned within the credit rating agency, we thought really about the financial impact. What could happen if there's a successful attack on an organization, and how could that lead to a weakened credit profile? How would it disrupt the core business? What were the reputational impacts that might occur? And what are the downstream effects that would happen to an organization if that occurred? When we performed that analysis, there were 13 sectors that we tagged as high risk or medium high risk. The paper's available on moodys.com, and of course, if you're interested and have trouble accessing it, just please let us know, and we're happy to get you a copy of that or subsequent research that the credit rating agency has done. So shifting back to cyber assessments, which is the business that I'm now building on behalf of Moody's and Team8, we really started to take a step back when we started to think about how to build up this business and think about this from a holistic perspective. And what we found is there are a couple of things that we think are missing from the market that people are very interested in. And when we're talking about people like boards of directors, senior business executives, regulators, et cetera, and there are really two things. One is being able to articulate cyber risk exposure in financial terms, and two is being able to do so in a way that allows for peer comparisons or benchmarking. When you talk to boards and business executives, these are really the two things that I think they're hungry for, that they're not really seeing in a meaningful way come out of other products, companies, or frameworks. So our goal is to really establish a holistic rating about cyber for individual companies that brings together a number of different tools and technologies and ideas into something that can generate an output that looks like a financial exposure measurement and also has a peer benchmark. And we also think it's important for that process and the way that we do it and the way that we arrive at this output or this rating be transparent, right? People who are going through the process ought to know how we're scoring different aspects of their organization. They ought to know how we've weighted certain factors. They ought to know how we think about the conclusions and how we've assigned the overall assessment as we go through the process. And the second thing is we think it ought to be independent, which means that when we're done with this process and we deliver the output to an organization, we're not going to do remediation work for that organization. We think that's extremely important to establish some independence around this. So from a technological perspective, we recognize that there are a lot of bits and pieces of the ecosystem necessary to do this in what we think is an insightful and meaningful way that already exist in the market. And you're probably familiar with most of these, but at the end of the day, we think bringing them together, assembling the puzzle in the right way is important from a methodological perspective. And so at the top, there's traditional management assessments, which are an organization comes into your company, talks to management, talks to security leadership, looks at things like controls, and comes up with an idea of how well defended the company is and how well it's doing from a maturity standpoint. There are lessons to be learned here. There are useful ideas that come out of this this type of approach. Some of the speakers earlier in the week talked about surveys. Surveys are a component of this. and we think there's value to them, but on their own, we don't think they can get to that point of establishing a benchmark and a financial exposure result. The second is outside in, or external scanning. We think this is a fairly novel approach and a fairly interesting new business that's been established over the last few years by a number of successful companies in this space, but we also think that on its own, it can't be a proxy for cyber risk exposure at the corporate level or at the organizational level. There are just too many blind spots. There's too much needed to sort of validate the data. And I think when you think about the audience here and you think about ICS, of course, this is probably not a good way to understand what the health and exposure of an ICS environment looks like. But we do think it's a piece of the puzzle. We think it has to be validated with inside information. And this is true for both the management assessment portion as well as for the outside in portion. You simply have to go into an organization and collect actual telemetry about either controls or technology or processes in a way that allows you to both validate the outside data and the results of the management assessment, and also do it in a way that is repeatable across many organizations in a consistent way. And what this means is that instead of measuring every control or every defense associated with every network or asset in a company, you really have to think about this as how can we rapidly measure things that are proxies for cyber risk and cyber risk exposure and defense, as opposed to measuring everything possible within an organization. And that's both a factor of efficiency, but it's also a factor of it's impossible when you execute this process to look at every possible point of interrogation on a network. And so we have to think about how to strike a balance between that. In addition, probability of loss modeling is important, understanding how similar organizations have been affected by cyber risk events and understanding what the financial impact of that looked like. That happens through the use of historical breach and loss data. And finally, that has to be put into a scenario context so that people can understand which of these events are relevant to their business, which of them are not as relevant to their business, and which of them are going to create that existential risk. So this is kind of how we're thinking about framing this up, and it's what we're doing as we start to build the methodology and test it in organizations that we're working with. There are a lot of challenges to be able to do this successfully, and I'll talk about 3 of them. The first challenge is that the loss data that's available to do the modeling necessary to understand what the potential financial exposure for a company is still in its infancy. It's gotten better over the last few years, but there's a lot of work to be done. And a couple of issues with the data today is that not all of the data is available publicly or even commercially. Some of it is not shared with the broader market. Some of it is kept as highly proprietary. And I'm talking about, in some cases, anonymized information. Some of it is kept very closely guarded in other organizations, such as insurance companies, insurance brokers, et cetera. And that creates a lack of high fidelity information that could be available for companies to be able to do loss modeling and understand how they might fare if an exposure occurred or if a successful event occurred. There's also a sizing issue with these data sets and a fidelity issue with these data sets. So if you look at some of the ones that are commercially available, we looked at one large commercially available data set, which has around 130,000 breach or loss entries. Only about 4% of those entries have complete enough financial information to be able to really do the probability of loss analysis that we think is necessary to do this in a very mature way, which of course reduces the sample size significantly. And depending on how you run the statistics on this, you could probably get that number up to say 8% or 12 or 15% if you use some techniques to fill in the data. but you're not going to get that number up to, say, 50% just using those techniques. So more has to happen to make those data sets not only larger, but also more complete when you think about other aspects or other areas where this type of loss modeling occurs, such as for property and casualty. The data sets are in the millions and tens of millions. So just to give you some comparative thoughts on this. The other issue is that about 85% of the data in these data sets tends to be US-centric, which isn't a surprise because disclosure has just been happening for a little bit longer period of time in the US. If you were here for Lisa Soto's talk yesterday, you saw the number of privacy regulations, 54, I think she said, in the US, all 50 states plus a number of territories. And this is sort of driving the data toward a US-centric view. The other issue is that it's also very privacy breach-centric. So the data doesn't tend to cover a lot of disruption events, which are still underreported and which still need more of a presence in these data sets. So that's issue one. The good news is the disclosure rules are helping. I think there's an industry-wide interest to make this better. And so you see a lot of grassroots efforts, people using new techniques to try to get at this information, people really focused on these data sets, and we're focused on this as well. And I think this is something that will continue to improve over time. The second issue is that to do this with efficiency and at scale, you have to balance the speed at which you can collect data and the effort level for both the company that's building the methodology and performing the assessments and the ratings with the effort that the company being assessed needs to put in to be able to have a successful outcome or have a measurable outcome. And so if you think about the different techniques you might use to collect information, going back to that sort of holistic view that I showed a couple of slides ago, you can sort of think about outside in, which might be scanning organizations, internet edge, but it could be other, picking up other data sources that are not necessarily technical in nature. This is a very low effort way to get information about an organization, but it can also be very low fidelity. And so on its own, not enough to really go through the process, but super efficient, and you can do it at scale very easily. As you sort of step up that curve and you think about other ways to go at an organization and get information so you can pull it into a model and a methodology, there's of course surveys, which get you some additional information about a company, but it's really a self-attestation, and that goes for surveys as well as cases where companies are providing report output that they generate that you could consume into a model. But to do this with the level of fidelity that we think is necessary to build a defensible methodology, you really have to go inside an organization. And this really means a combination of either being able to do some direct data sampling so that you're not simply relying on individual organizations to self-report in a way that you think is valid, but it's also probably going to involve running some tools and some tests within the organization to look at very specific technical attributes of the organization. And we think that's necessary because there are just certain things that you have to test with tools that can't necessarily be represented by data and reporting. And so we think this is vital to the ability to establish a global methodology around this and establish a rating around it. There's another factor here, which is effort is also a proxy for time. And so this is something that we really think has to be done in a measure of weeks as opposed to something that's measured in months in order to have value for organizations and for consumers of the output rating, which might be the company's board of directors, or it might be the company's insurance underwriter, or it could be the company's regulators. So these are all things that we're thinking about as we move through the methodology development and we start to establish this business and start to talk to people like you about it. I think the other thing to consider is that as we look at ways to do this, automation becomes kind of a key play here. The more we can automate, the more we can reduce friction with an organization as we want to collect information and start to build it together into this rating and assessment process. The third challenge is, as shifts in technology occur, those shifts impact the way we measure cyber risk. And so going back to the work that was done in the credit rating agency, where we said digitization is increasing, this is causing a rising tide in cyber risk. And as a result of that, the risk factors increase and the complexity increases with it. When you think about how you might measure different signals for cyber risk or cyber resiliency in an organization, the shift from legacy data centers to cloud has an impact on this. So if you're familiar with concepts like pets versus cattle or immutable and destroyable technology, when you think about uptime, for example, as a proxy for cyber resilience or even just technology resilience, and you look back 15, 20 years ago, a very long uptime on a technology asset was considered to be sort of an indicator of stability. That's really not true anymore. If you have an environment where average uptime today is measured in months or longer, it's probably an indicator that you're slow and not agile, and you can't refresh the infrastructure with enough speed in order to manage through cyber risk events or other technology impacting events. So you have to think about how some of these signals flip when you shift technology and the way that technology is delivered. The second issue is that things that we used to think were good advice, that may have been things we thought about measuring from a cyber risk perspective, have just been proven through research to not be good advice. Perfect example of that are the changes to password rules or password guidance that, as information security professionals, we've given to users for the last 20 plus years. Expiration is a perfect example of that. 20 years ago, we told users that they had to change their passwords frequently. There were presumably good reasons to do this, such as your colleague discovered your password and they now have access to your account, and if you don't change your password, they're going to have access to your account forever. And obviously, there were many changes in techniques that didn't really make that necessary due to persistence and other issues, and we did a lot of research into password breach data sets, and we realized that actually changing passwords is probably not good advice, and people except in certain event-driven circumstances and except in certain cases, probably just not the right way to handle some of these issues anymore. So if we were measuring that as a signal for cyber maturity at a company, we would have to eliminate that signal from our methodology and think about how to replace it with something that had a different level of fidelity and was a different indicator as a result of some of the changes in the way that we think about security. So these are all things we like to kind of call that signal decay, which is that things that you measure today might be extremely valuable in terms of relaying the overall cyber hygiene and health and exposure of an organization, but they just may not be valid in 12 months or 2 years or 5 years. And so you have to think about how a methodology survives those changes in the underlying signals and metrics and data collection points. The other issue, obviously very relevant for this audience, is that measuring security for an ICS environment is obviously dramatically different than doing it for a standalone technology environment. And so we're not really far down the path of thinking about the ICS environments yet, but one of the reasons we wanted to come today for S4 is because this is something we're thinking about, and it's something we know we're going to have to tackle as we progress. I think we're lucky to have Team8 involved and the folks at Clarity involved in some of the discussions we're having around that, so that when we do deliver something that is relevant to the sectors that you represent that do have a high presence of ICS and control systems, we have something meaningful to talk about as we think about measuring this. Finally, how do we think about a rating scale? So there's a couple of ways to sort of consider this. Still very much evolving, but there are lots of good sort of options out there in the market. I can sort of talk at a very high level about things we think we won't do, things we think we might do, but it's still reasonably early days and we're still considering some of this. So unlikely is a standard 0 to 100 point scale, or even a more sort of consumer credit style scale. And the reason for that is, one, it implies false precision. The difference between a 55 and a 56 is probably not really measurable or representable. And certainly the difference between a 328 and a 327 is probably not that describable either. The other issue is that I think when you use scales like this, you're sort of implying that it's a deterministic scale and that there's some computability to it. And we believe the output scale for something like this needs to be ordinal in nature and be focused around cohorts. And so the types of scales that you see on the left are probably not what you'll see when we actually do a formal product launch in the future. What we will probably do, and this is just meant to be an idea, not something we've committed to yet, is develop a scale that looks a little bit like what you would see for credit, but represents something very different, which is, in this case, the thought is partitioning the results into companies that have a reasonable possibility of defending against a sophisticated attack versus companies that are able to defend against a commodity attack, and then organizing into ranked cohorts within each of those partitions in a 8 or a 10 or a 15 point scale based on a function of all the other things that we're measuring. And so you could also think about this as there's a group of organizations ranked in each cohort that are above what we call, what others have called the cyber poverty line, and there's a group that are below. And another way to think about that, and if you look at the paper that I mentioned that we did in a credit rating agency last year, we talk about the rising tide of attacks, both from a frequency and a sophistication perspective, and the need for organizations to raise their defensive baseline in a way that is commensurate with the rise in attack complexity and frequency. And this is another way to kind of think about that breakpoint on a potential future state scale. And it's something we're thinking very carefully about as we establish the process to measure this and the process to explain it to folks like you and other participants in the market. Appreciate the time today. This is not something we want to do in a vacuum. It is something where we absolutely want community input, and so we're happy to have a dialogue with any of you about what we're doing, how we're doing it, and it is something that we expect ought to be transparent to market participants, consumers of the ratings, buyers of the ratings, and it's something that we think will have a very dramatic impact on the way that people talk about cyber risk moving forward. Just want to say thanks to everyone, thanks to Dale, and appreciate the time and all the other organizers at S4. Thank you.